Something unprecedented is happening in global metals markets right now, and most people have no idea what is actually driving it. Chinese speculators flushed with liquidity and starved for investment options are driving copper, gold, and silver prices to historic peaks. We are watching approximately $7 trillion in household time deposits mature this year with nowhere productive to go. And that money is flooding into commodities futures markets at an extraordinary pace. Let me be direct with you. This is one of the most important dynamics in precious metals right now. More important than Fed policy, more important than inflation data, more important than geopolitical tensions. Because when you have $7 trillion seeking returns in an economy where real estate is perceived as loss-making, bank deposit rates are meager, equity markets face regulatory pressures, and bond yields are subdued, that capital has to go somewhere. Right now, it is going into gold and silver. This channel is built on factual analysis covering both bullish and bearish factors. That is how real markets work. Anyone promising you certainty in uncertain markets is selling you something, usually disappointment. Now, let me break down what is actually happening because this story is much bigger than the headlines suggest. China's M2 money supply is growing at an 8.5% annual pace. Let that sink in. 8.5% money supply growth. Meanwhile, nominal GDP growth sits at just 3.9% as of late 2025. That is a 4.6 percentage point gap between money creation and actual economic output. Where does that excess liquidity go? It has to go somewhere. Money does not just sit idle, it seeks returns. And right now, the path of least resistance is commodities, futures, markets. This is not speculation on my part. This is documented fact. The People's Bank of China has the capacity to ensure ample liquidity and lower interest rates. They have been doing exactly that. But here's the problem they cannot solve. They cannot create compelling domestic investment opportunities. The real estate sector is in crisis. Fixed asset investment has contracted for the first time on record. Banks extended the fewest new loans since 2018. Where exactly is productive capital supposed to flow? The answer is it flows into financial assets. Gold, silver, copper, aluminum, nickel, steel, wire, rod. We are seeing record activity in futures markets for all of these metals, and the driver is not industrial demand. The driver is surplus liquidity seeking any return in an environment where traditional options have failed. Let me give you the specific numbers, because data matters more than narratives. Silver prices stopped falling and rebounded today. According to the latest SMM daily review, market supply remains relatively tight. In Shanghai, supplier quotes show premiums of 3,500 to 3,800 DW per kilogram against TD. Some suppliers are holding prices firm at these elevated levels. A few suppliers concerned about potential premium reductions made just-in-time procurement at premiums of 2,300 to 2,400 yuan per kilogram against the 2604 contract. In South China, smelters offered cargo self-picked up from production sites at premiums of 2,400 yen per kilogram against the 26,004 contract. Some suppliers mentioned slightly lowering premiums against TD to 3,200 yuan per kilogram due to difficult transactions at high premiums. Read that carefully. Transactions are becoming difficult at high premiums. This is significant. When premiums get so elevated that actual physical transactions slow down, it tells you something important about the sustainability of current price levels. The physical market is sending signals that the futures market may be ignoring. Here's where it gets really interesting. The Shenzhen market, which is one of the largest physical gold and silver markets in China, is showing declining procurement and stockpiling enthusiasm. A strong wait-and-see sentiment is prevailing. Overall transactions are described as relatively weak. After the overheated market cooled down, buyers are stepping back. This is the divergence I want you to understand. Futures markets are surging on speculative liquidity flows. Physical markets are showing caution and weakening transactions. When these two dynamics diverge significantly, one of them eventually has to adjust. Either physical demand catches up to justify futures prices or futures prices correct to meet physical reality. History suggests the latter is more common. Let me ask you something. Are you seeing this divergence between paper and physical in your local market? If you are a stacker, if you buy physical silver or gold, what are premiums looking like where you are? Drop a comment below. I genuinely want to know what conditions are like on the ground in different parts of the world. Now, let me explain the structural shift that is creating this liquidity flood. This is crucial for understanding why this situation may persist longer than skeptics expect. Approximately $7 trillion in household time deposits are maturing in China this year. $7 trillion. That is not a typo. This vast pool of savings was accumulated over recent years amid property sector instability and lackluster equity market returns. Chinese households facing uncertainty about real estate values and stock market volatility park their money in time deposits. Safe, boring, low yield, but safe. Now those deposits are maturing and savers are facing a decision. Where do they put this money next? Let me walk through their options. Real estate perceived as loss-making. The property crisis is well documented. Developers defaulting, prices falling in many cities. The cultural assumption that property always appreciates has been shattered for many Chinese households. This is not an attractive option. Bank deposits rates are meager. Why lock up money for another term at yields that barely keep pace with official inflation, let alone real inflation? The opportunity cost feels too high when other assets are surging. Equity markets facing regulatory pressures and volatility. The Chinese stock market has been a source of frustration for domestic investors for years. Periodic crackdowns on various sectors create uncertainty. Returns have been disappointing compared to other options. Bond yields subdued, not compelling enough to attract significant capital flows from yield-seeking savers. So what is left? Gold and silver. These are emerging as rare investment options in an environment where alternatives have failed. And gold has additional cultural significance in China as a store of value and household savings that extends beyond mere financial hedging. This is not just about returns. This is about trust. Chinese households trust gold in a way they no longer trust property developers or stock markets. The data confirms this shift is real and accelerating. Gold-backed financial products in China have more than doubled in number over the past 2 years. Their total value has increased 8-fold. Let me repeat that. 8-fold increase in value over 2 years. This is not marginal reallocation. This is a material shift in how Chinese households are storing wealth. Now, I need to give you the honest risk assessment because this channel covers both sides. The bullish case is clear. Massive liquidity seeking limited options. Structural demand from the world's largest savings pool. Cultural affinity for gold. Supply constraints for physical metal. All of these factors support prices. But the bearish case deserves equal attention. The divergence between futures prices and physical demand creates vulnerability. Manufacturing entities that rely on these metals for consumer goods and infrastructure have scaled back procurement rather than absorb inflated costs. When industrial buyers step back, it tells you current prices exceed what the real economy can support. The fervor in futures market stands in stark contrast to softening physical demand. This disconnect signals a potential asset bubble where financial market valuations are divorced from underlying economic fundamentals and real-world consumption. Those are not my words. That is the assessment from analysts covering Chinese commodity markets. Market participants cite long-term justifications, currency debasement for precious metals, the green transition creating structural demand for copper and silver, AI-driven demand for various metals, data center build-outs requiring massive copper inputs. These are all valid fundamental arguments. But here's the honest question. Do these long-term factors fully explain the current price trajectory against a backdrop of deflationary pressures and industrial overcapacity within China? The answer is probably not. The speculative component appears dominant in current price action. That does not mean prices cannot go higher. Speculation can persist longer than fundamentals suggest, but it does mean the risk profile is elevated. Let me talk about what the People's Bank of China is doing, because their policy decisions directly impact this situation. The PBOC is committed to economic support. They want to stimulate growth. They want to encourage lending and investment, but they are also wary of asset inflation. This creates a dilemma. If they ease policy aggressively to combat sluggish growth, they risk exacerbating bubble concerns in commodities and other financial assets. If they tighten to cool speculation, they risk choking off the economic recovery they desperately need. There is no easy answer. Historically, the PBOC has opted for targeted liquidity measures rather than broad rate cuts to manage this tension. They try to direct capital toward productive uses rather than just flooding the system with money. But in the current environment where M2 growth consistently outpaces nominal GDP, they are clearly struggling to direct capital toward productive economic endeavors. The commodity price action may be magnifying this problem rather than resolving it. What happens if global economic conditions deteriorate? This is where the speculative rally carries substantial risk. The divergence between futures prices and physical demand suggests vulnerability to sharp corrections should market sentiment shift. Unlike the 2002 to 2011 bull market, which was driven by genuine industrialization demand from China's infrastructure build-out, the current rally is largely driven by excess liquidity seeking any yield. That creates a potentially unstable scenario. When prices are driven by fundamentals, corrections tend to be measured because buyers step in when value emerges. When prices are driven primarily by liquidity flows and speculation, Corrections can be violent because the buying pressure evaporates when sentiment shifts. I want to be clear about something. I'm not predicting a crash. I'm not telling you to sell everything. I'm explaining the risk factors that exist in the current environment. This channel is about understanding markets, not about pushing you toward predetermined conclusions. You need to make your own decisions based on your own risk tolerance and time horizon. Speaking of time horizon, let me share something important. If you are a long-term holder of physical precious metals, short-term price volatility driven by Chinese speculation may be irrelevant to your thesis. You are not trying to trade futures. You are not leveraged. You are accumulating real assets for long-term wealth preservation. In that context, whether silver trades at $75 or $85 or $70 next month matters less than whether you believe the long-term trajectory is higher. But if you are trading leverage positions, if you are trying to time short-term moves, if you are operating with capital, you cannot afford to lose. The current environment demands extreme caution. The speculative dynamics can reverse quickly. The divergence between paper and physical can resolve in either direction. Position sizing and risk management matter more than being right about direction. Let me give you some global context because China is not operating in isolation. Analyst sentiment is divided regarding the sustainability of the metals rally. Some foresee continued support from structural supply deficits. Copper mines are aging. New discoveries are rare. Permitting for new mines takes years or decades. The green transition requires enormous quantities of copper, silver, and other metals. AI and data center buildouts are copper intensive. These structural factors are real. Others caution that current price levels are unsustainable without a corresponding rebound in global manufacturing and Chinese domestic consumption. Forecasts for China's 2026 GDP growth range between 4.5% and 5%. Continued sluggishness is expected in consumption. A modest recovery in fixed asset investment is projected but insufficient to justify current commodity price buoyancy. Global manufacturing PMI data presents mixed signals. We are seeing moderating growth, not acceleration. This could temper commodity demand if the trend continues. The industrial buyers who actually consume these metals are showing price sensitivity. They are not aggressively restocking at current levels should inflation pressures persist globally. Central banks may maintain higher interest rates for longer. This potentially increases borrowing costs and reduces speculative appetite for commodities. The Fed, the ECB, the Bank of England, all are watching inflation data carefully. If they cannot cut rates as quickly as markets hope, the liquidity tailwind for commodities could weaken. Now, let me connect this back to what you can actually observe in the market. The Shanghai silver market is showing premium compression after an overheated period. Some suppliers are lowering quotes because transactions at the highest premiums have become difficult. This is the market telling you that a ceiling may be forming, at least temporarily. The Shenzhen shoe market, a key indicator of retail physical demand in China, is showing wait-and-see sentiment. Procurement enthusiasm has declined. Transactions are relatively weak. When the physical market cools while futures stay elevated, that gap eventually closes. Under conditions of high premiums being difficult to preserve value, traders show very low intention to purchase and build positions. This is direct market intelligence. The people who actually trade physical metal for a living are stepping back. They are not chasing prices higher. They are waiting. Does this mean the bull market is over? Absolutely not. It means the market is digesting gains. It means speculative excess is being worked off. It means we may see consolidation or correction before the next leg higher, or it could mean a more significant repricing is coming. The data will tell us. We do not need to predict. We need to observe and understand. Let me talk about the $7 trillion factor again, because I think many people underestimate how significant this is. When $7 trillion in time deposits, matures, and savers face the question of reallocation, the decisions made by millions of Chinese households will influence global asset prices for months or years. Some of that money will stay in deposits despite low yields. Safety and liquidity have value, especially in uncertain times. Some will flow into real estate despite the sector's problems. Chinese real estate is not uniform. Some cities and segments still attract capital. Some will flow into equities, especially if government policy becomes more supportive of stock markets. But a meaningful portion is flowing into gold and silver. The gold-backed product explosion confirms this. The elevated premiums in physical markets confirm this. The surge in futures trading volumes confirms this. This is real capital flow, not just sentiment. The question is sustainability. Will this flow continue at current intensity? Will it accelerate as more deposits mature? Or will some triggering event cause savers to reassess and pull back? If Chinese households continue allocating even a small percentage of their savings to precious metals, that represents enormous demand in a market with limited supply. Global silver mine production is roughly 800 million ounces annually. Global gold mine production is roughly 100 million ounces. Even small percentage shifts in Chinese household allocation move these markets significantly. But sentiment can shift if gold and silver prices correct sharply. If savers feel burned by losses, the flow could reverse. Chinese retail investors have shown capacity for both euphoric buying and panicked selling in other asset classes. There is no guarantee precious metals will be different. Let me give you the PBOC perspective because understanding their constraints helps you understand what might happen next. The People's Bank of China is walking a tightrope. On one side, they need to support economic growth, sluggish consumption, weak fixed asset investment, banking sector stress. All of these argue for easier monetary policy. On the other side, they are watching asset inflation with concern. When excess liquidity flows into commodities rather than productive investment, it creates distortions. Manufacturers face higher input costs without corresponding demand for their products. This squeezes margins and discourages the very investment the PBOC is trying to encourage. Any significant policy easing to combat sluggish growth could exacerbate bubble concerns, but tightening to cool speculation could choke off recovery. The PBOC has historically preferred targeted measures over blunt instruments. They try to direct credit toward priority sectors. They use macro-credential tools to cool specific markets, but the current situation may be beyond the reach of targeted measures. The gap between M2 growth and nominal GDP growth suggests liquidity is consistently being created faster than the real economy can absorb it. This is a structural challenge, not a temporary imbalance. Until that gap closes, surplus liquidity will continue seeking returns wherever it can find them. I want to share analyst projections because having context for different viewpoints matters. Some analysts see the current rally continuing. They point to structural supply deficits, copper inventories at historic lows, silver industrial demand growing from solar and electronics, gold's role as a currency hedge in a world of fiscal excess. These arguments have merit. Other analysts see current prices as unsustainable. They point to the divergence from physical demand, manufacturing PMIs moderating, Chinese consumption remaining sluggish, the speculative nature of current positioning. These arguments also have merit. The honest answer is we do not know which scenario plays out. Markets are complex systems. They do not follow simple scripts. What we can do is monitor the data and adjust our views as evidence accumulates. Key indicators to watch include Shanghai and Shenzhen physical premiums. If premiums compress further, it suggests physical demand is not keeping pace with futures. If premiums expand, it suggests physical tightness is real and supporting prices. Watch Chinese futures open interest and trading volumes. Elevated speculation leaves fingerprints in positioning data. Extreme positioning often precedes reversals in either direction. Watch PBOC policy signals. Any shift toward tightening or targeted measures to cool commodity speculation could impact prices quickly. Watch global manufacturing PMI trends. If industrial demand genuinely accelerates, it validates current prices. If industrial demand continues moderating, it raises sustainability questions. Watch the flow of funds data for gold-backed products. If that eightfold increase continues, it suggests the structural shift in Chinese savings is accelerating. If flows slow, it suggests the easy gains from reallocation may be behind us. Let me bring this back to practical implications because understanding the situation is only useful if it informs decisions. If you are a long-term physical precious metals holder, the Chinese liquidity dynamic provides tailwind for your position. $7 trillion seeking returns in limited alternatives supports prices structurally. The cultural shift toward gold as savings vehicle creates persistent demand. Supply constraints remain real. Your thesis is intact even if short-term volatility increases. If you are trading shorter time frames, respect the elevated risk environment. The divergence between paper and physical markets suggests instability. Speculative positioning can reverse quickly. Size positions appropriately. Use stops. Do not assume trends continue indefinitely. If you are considering new positions, the question is entry timing. Current prices reflect significant speculative premium above where physical transactions are easily occurring. That does not mean prices cannot go higher, but it does mean you are not buying at value levels. You are buying momentum. That requires different risk management. Now let me ask you directly, what is your read on the Chinese situation? Do you think the $7 trillion liquidity flood will sustain precious metals prices? Or do you see bubble risk that concerns you? Drop a comment below. I read every response and your perspectives help me understand what the community is thinking. Before I give you my 3 key takeaways, let me emphasize something. This channel does not tell you what to do with your money. I present data and analysis. I cover bullish and bearish factors. I try to give you the information you need to make your own informed decisions. Anyone promising certainty in uncertain markets is misleading you. The best we can do is understand probabilities and position accordingly. Make sure you join our WhatsApp community for updates as this situation develops. The Chinese liquidity dynamic will evolve, PBOC policy will shift, physical market conditions will change. You want to be informed in real time, not days later when everyone has already reacted. Link is in the description. Also follow us on X at Financial Crux. That is where I post quick observations and data points between these longer analyses. The algorithm does not always surface videos immediately, but X notifications are instant. Now here are my 3 key takeaways from everything we have covered today. Takeaway number 1, the Chinese liquidity flood is real and quantifiable. M2 money supply growing at 8.5% against 3.9% nominal GDP creates a 4.6 percentage point gap of excess liquidity seeking returns. Approximately $7 trillion in household time. Deposits maturing this year with limited attractive alternatives. Real estate perceived as loss-making. Bank deposit rates meager. Equities facing regulatory uncertainty. Bond yields subdued. Gold and silver emerging as rare investment options with cultural significance beyond financial hedging. Gold-backed financial products more than doubled in number with 8-fold increase in value over 2 years. This is not marginal reallocation. This is structural shift in Chinese household savings behavior. Takeaway number 2, the divergence between futures and physical markets signals elevated risk. Shanghai silver premiums at 3,500 to 3,800 WN per kilogram, but transactions becoming difficult at high premiums. Shenzhen Bay market showing declining procurement enthusiasm and wait-and-see sentiment. Manufacturing entities scaling back procurement rather than absorbing inflated costs. Traders showing very low intention to purchase and build positions under high premium conditions. When paper prices surge while physical market cools, that divergence eventually resolves. History suggests paper usually adjusts to physical reality rather than the reverse. This does not mean prices crash tomorrow. It means risk is elevated and positioning should reflect that. Takeaway number 3, the PBOC faces an impossible dilemma that may prolong this dynamic. They need to support sluggish growth but are wary of asset inflation. Easing policy could exacerbate commodity speculation. Tightening could choke off recovery. Historically, they prefer targeted measures over blunt instruments, but current liquidity excess may exceed targeted tools. The M2 to GDP gap represents structural challenge directing capital toward productive uses. Until that gap closes, surplus liquidity continues seeking returns in commodities and precious metals. Global context matters too. Manufacturing PMIs moderating. Inflation keeping central banks cautious. Analyst sentiment divided between structural bulls and sustainability skeptics. The resolution will come from data, not predictions. Here is the honest uncertainty we face. Is the Chinese liquidity flood a sustainable tailwind for precious metals that persists for years as household savings continue reallocating? Or is it creating a speculative bubble that corrects sharply when sentiment shifts or policy changes? Both scenarios are plausible. The structural arguments for precious metals remain valid regardless of Chinese speculation. Supply constraints are real. Currency debasement concerns are valid. Industrial demand from green transition is growing, but the magnitude and pace of current moves appear to exceed fundamentals. That creates elevated risk alongside elevated opportunity. My view is that long-term holders should not be shaken by this analysis. Short-term traders should adjust position sizing to reflect elevated risk. New money considering entry should recognize they are buying momentum, not value at current prices. Time horizon determines appropriate strategy. The next several months will reveal whether Chinese household reallocation into precious metals accelerates, stabilizes, or reverses. PBOC policy evolution will influence outcomes. Global manufacturing trends will validate or challenge current prices. Physical market premium trends will signal whether paper and physical are converging or diverging further. Do your own due diligence. Understand the risks on both sides. Recognize that the same factors creating opportunity also create risk. The $7 trillion liquidity flood supports prices, but also represents hot money that can flow elsewhere if conditions change. The divergence between paper and physical is a warning sign, but not necessarily an imminent crash signal. The PBOC dilemma suggests this dynamic may persist, but policy shifts could change everything quickly. Markets do not care about narratives, they care about flows. Right now, flows favor precious metals, but flows can reverse. Position accordingly. One more question before I go. Are you more concerned about missing upside or more concerned about bubble risk? There is no right answer. It depends on your personal situation and risk tolerance, but knowing your own psychology helps you make better decisions. Drop a comment with your honest assessment. Remember, this is not financial advice. This is analysis and information sharing. Your decisions are your own responsibility. Invest with logic, not emotion. Size positions you can hold through volatility. Understand that being right about direction does not help if position sizing or leverage is wrong.